Okay, let's dissect our QQQ. Okay. So initially, and I'm gonna just break this down from the get-go. Okay. On exact date here. Okay, on March 7th. Can you guys all hear me okay? Okay, we bought the April 18th 176 180 call spread, and we paid $1.20. Okay, on March 12th, we sold half the above position, just to take a little off the table, for $1.90. Okay, everybody with me? Okay. On March 13th, we sold the March 22nd. Oh, I just got my notification also, guys. All right, I'll get that on the board here shortly. We sold the March 22nd 179 181 call spread, and we collected 40 cents. Okay, and then today, on March 22nd, we closed everything out for $1.50. Now, how does that play into the individual spreads? We can break it down. Okay, so let's talk about the first part. Okay, so the first part that we closed out half, we made 70 cents on a $1.20 investment, so 58% on half of our position. Okay, everybody following? Okay, now, for the other half, there's two ways to look at the remainder of what we did. Okay, there's two ways to look at what we did. Anybody want to suggest out to me what those are? And again, it's just a matter, we're going to come to the same exact conclusion. It's just looking at it two different ways. Some may understand one way better than the other. So I want to break it down both ways, make it as simple as possible. Enrico, why you filled at 97 cents in EA? Why? Sorry about that. Let me talk into the mic better. Okay. So what are the ways that we can look at the balance of this QQQ position? Okay. For the remainder of the position, we can look at it two ways. Okay. One, what price did we essentially have the combination of the original and the adjustment as a spread? What price did we have that on as together? And remember, this is for half of our original position. Good. Anybody besides Todd? 80 cents is correct. Okay, so the remainder was a debit of 80 cents, right? The $1.20 we originally paid, less the 40 cents we collected. Okay, everybody follow that? Okay, so if we sold that for $1.50, right? Then we actually made $88 on the balance of that spread, 70 cents. Right? We made 70 cents on an 80-cent investment. The other way to look at it would be just to break down the individual prices that we did both spreads at. Okay, so the, whoops, I don't know why that happened. So the April, come on, whiteboard, don't mess with me now. Okay, so the April spread we bought for $1.20 and sold on this last go around. Okay, we sold it on this last go around, just the April part of the spread. If you isolate that part, my prices were $2.72. You guys may have a little bit different pricing, but the net is all going to be the same. The March spread, we sold for 40 and bought back today. Obviously, that's going to be the losing side of that. Mine was $1.22. Okay, watch how the math works out. Plus $1.52 minus $82 for a net of the same 70 cents that we just calculated in example 1 above here. Everybody following what I did here? Again, I just wanted to break this down in two different ways. Does everybody follow that? So then, as an overall percentage, okay, as an overall percentage, if we just, kind of take the math, if we take 58% on half, and we take 87.5% on half, okay, the average of that is 72.75%. I know a little convoluted, a little, long-winded to get there, but I just kind of wanted to work through that. Does that make sense for everyone? I got you, Todd. I got you. I'm just calculating in the entire, everything we did from start to finish. Because you know what, guys? You guys should understand every single trade you make. What happened along the way? What happened as an exit? You know, going back through a review of something like this is only going to help you moving forward. Not only to figure out mathematically profits and losses, but you can, you know, break down here, okay, the adjustment we made on March 13th, obviously in hindsight, you know, if we had that rear view look and mirror instead of that crystal ball, but if we had that rear view look and mirror, in hindsight, for the overall profitability of our position was not a great adjustment. But at the time, it was a fantastic risk adjustment to be able to take some profits off the table, right? Okay, does all of this make sense? And if it doesn't, it's okay to speak up. I'll go through it again. If not, you know, this is all recorded. You got the whiteboard. I'm going to post it up here. I'll post the recording up there, and you can go through all the math behind it. Todd, you didn't know what you were getting yourself into, right? When you asked the question on how much we made. But this is how my funky mind works, though, with numbers and math. Gotcha, Michael. Well, when you review, whether it's over the weekend, next week, whenever it is, if you have any questions, just you know, just take a look. Just let me know. I look at it, Todd, as an overall position. We had a QQQ position on, and net end of the day, we made 72.75%. That's how I'm basing the overall profitability of this trade. But you can't look at the original investment, Todd. You can't do that. What you can do is go to your trading sheets and just look at the overall amount you paid. So your overall debit that you originally paid, and then your overall credit, and just base it off of that. You should come up with the exact same percentage profitability. You know, so if your net investment overall of the entire position, remember we're talking about the entire position. If your overall investment was $100, based on the 72 and change percent return, your credit back should have been $172. All right. All right, guys, let me wrap this up, get the video posted here. I'll put the whiteboard up in the, hang on, QQQ overall position, dissection 322.19. Get this on the board here. Hey, don't call me unorthodox, Jaytano. I'm as orthodox as they get. No, I'm just Jaytano. I'm just kidding. I'm just kidding.